so it's available for them as well. Okay. Okay. So before you arrived, Parveen bhai, I was just discussing with Malik, and he was mentioning that he's planning to register for the exams and stuff. So actually, that's a good discussion because we want to talk about something there. So
Yeah, I'll help him.
okay.
अपर्णा जी का भी एग्जाम का रजिस्ट्रेशन बाकी है.
20. Okay.
So Maulik bhai, what did you read last week?
I read life insurance. Almost completed 4 chapters.
Okay.
Going to start a 5th one. And in like 4th chapter, I am reading and watching videos parallelly.
Okay. So this is another announcement for our team Sandeep Big Leap.
So Maulik bhai, and Sweta ji, as I'm getting like more and more experience with the business,
May 20th.
I am highly convinced that this definitely is a big opportunity in the market. Hello.
Yes.
You take
Yeah,
that.
this is a big opportunity in the market in terms of the need. The more I meet the people, I realize that they do not have basic information about like protection and investment need and opportunities. So I think the more we are delaying to complete the process, you are essentially losing the opportunity. And I think for myself, I lost many months, or because I did not like really understood this properly. I don't want you to make the same mistake. Okay, so the sooner you start and get into depth of things, this is really a very genuine opportunity and has big potential for replacing what you are doing right now, your income, or at least supplementing that in a major way. So to to put the money where your mouth is, our team, we are announcing this thing that we are so convinced that we are willing to essentially almost cover your cost for the process for the exams. Okay, how we will do that is shown here on the screen. So first step is internal exam, of course, right? So for enrollment, do it right away if you've not done that. Okay, we are saying that for enrollment, there will be incentive of $50 for that, and upon success, it will be additional $150 gift cards. Okay, so $200 you can call it scholarship or incentive, whatever. That's available to you if you complete your internal exams, I would say by 20th May. So 1 month, today is 19th April. So 30 days if you complete the exam process. That's a $200 gift card. Next step is of course provincial exam. So once you complete your internal exam, you can register for provincial exam. Register for all the 4 papers. That's an enrollment incentive of $50 right there. Upon the success of that, there will be another $150. Timeline is 20th June. So 2 months from now. Okay. So total $400, which is pretty much the cost of the 2 exams. I think exam maybe like $450 something. So almost $400 is being paid to you to just complete the exam. So like essentially the cost to you is zero or negligible, right? And on top of that, from your upline, in this case, for example, Maulik bhai, your upline is Parimal, and Sujata ji, I think your upline is Parimal as well. So There's another incentive from the applying side. In my case, people who are reporting to me directly, they are they're applying. So once you complete your associate run, which is 3-3-30, which is what Parimal did a couple of 4 weeks ago. So 3 recruits, 3 PFS, right? Within 30 days period. So that is your associate run, and that's another $200 gift card. Okay. So this $600 is available for taking. Anyone who is willing to take this challenge, go for it. And $600 is covering your entire program. Basically, that's the process pretty much, right? On top of that, if you remember, there is some incentives which are from the Team Prosper side, which was, I think, in 4 months of your enrollment, if you complete your license and you get $500 business, they were, I think, offering $500 incentive. So that's announced every program, every session. So that is still available. That's over and above this. That does not have to do anything with this thing. This is only for our own team, and keep it confidential. Keep it within the team. It's not like no other team is offering this thing, and we don't want this to be like people to feel differently in other teams. So we just keep this within the team. Okay. So Sujata ji and Maulik bhai, any questions on this program?
Not at all.
No.
Okay. So Maulik, what do you think about this program? Like, how does it change your motivation or commitment?
Yeah, I was in dilemma that when to enroll for exam, how to read and all stuff. But after seeing this one, I'm pretty confident that I'm definitely going to register by this weekend, and preparing hard to clear internal exam by May. I was thinking for end of May, but right now I'm going to prepare myself more about to achieve this $200 by May 20th.
Perfect. And Maulik bhai, trust us, it's just a matter of putting the faith. You will, enroll the exam. You start writing this thing. This is not difficult. Like, it's like sometimes just we get into that mental block, right? Book it, try one exam, nothing to lose, right?
Yeah.
Try that thing, and this is not that complex. Like, a couple of times you study, and like through all these sessions, you're getting knowledge as well. Watch videos and stuff. This is not difficult. Parimal bhai, please.
So Maulik and Sujata, both of you, once you register, Sujata has already registered. Once you register, when you log into that Oliver training thing, you have the ability to take the mock exam.
That's what I was going to ask, if there is any mock exam.
So you can try it. I can help you how to do it, right?
Okay.
So try the mock exam. Once you register, you'll be able to do it. And they give you the same amount of question and the same amount of time.
Okay.
So try it a few times. But
Okay.
that is a good practice. Once you have a little bit confidence that I can take it, take it.
Sure, we'll do that.
Thank you, sir. So we are on what, universal life now?
No, we completed universal life discussion last session. Anand is saying that he's in the meeting, but I can't see him.
I don't see him.
Yeah.
What meeting is he in?
I don't know. I sent him link twice or thrice, but I don't know which meeting he is.
Let me call him.
Yeah.
If he picks up. And Aparna ji joining or not?
She was driving, so as soon as she reaches home, she'll be joining.
Okay.
Yeah. This guy did his interviews, son. Okay. So, Maulik, can you try to describe for me?
So we have some. Sorry.
Yeah, go ahead.
We have some Nikunj Singhania in our team too.
Yes, yes.
Okay, I haven't met him. That's why.
Yeah, yeah. He's joining us as well. So it's 3 meetings back to back. Yeah, that's fine. That's fine. He has some meetings. Anyway, that's fine. I'll meet him separately anyway. He was away to India for like almost 4-5 weeks, so I have to catch up with him. Okay. Maulik bhai, just a quick test of your recollection from the last meeting, last discussion. So for universal life, what is yearly renewable term?
Yearly renewable term means the person, like the client, has authority or maybe ability to renew the insurance like policy after like it's expire, and I think they don't have to go for a medical checkup again.
That is renewable. That's the word, renewable. Yeah, but yearly will be slightly different. Slightly different. Like there's a little bit more to that. Suyata ji, kuch yaad hai?
Because I wasn't available in last meeting. I
Oh, you're not
was
in that. Okay, okay. No problem. No problem. So I'll explain to you by an example again. So what I take, for example, I'm at the age of say 40, right? I want to take a policy up to for like for universal life, so that will be till end of my life. So there are two ways of insurance, right? So one is that I can agree with the insurance company that I will take pay level charge, like meaning is same charge from now till whatever period of time, right? 65 or 55, I can choose that. So I'll be paying same amount every year for my insurance. Okay. The other way could be that I will tell them that, see, I will pay you whatever, like contribution of $300, but I want you to charge only that much amount, which is for me as per my age for that year. So at age of 40, my insurance cost or my mortality charges for insurance company might be say $81. So I will pay from my contribution of $300, 81 is getting charged towards insurance for that year. Next year, that will change. My age has increased, became 41. So that may become 80, from 81 to 83. Okay. So next year, when I'm paying $300, 83 will get charged. The next the further year, it will again change. Okay. So yearly renewal means that I am paying the insurance cost as per my age for that year, and it will keep on changing as the year progresses. So from my contribution, the insurance portion will keep on increasing. So that is yearly renewable. Why we prefer that, especially for younger people, why we prefer that is that insurance component, we want to keep it smaller. Investment component, we want to keep it bigger from your contribution. Investment has more chance to grow faster, right? So in future, even if your insurance increases, your investment growth will make up for that, will do better, rather than your your insurance will increase, but your investments have increased further faster. That is the logic behind this one. Okay, so that is called yearly renewable term. But Maulik, what you explained about this thing, the renewable, that's the definition for renewable, like meaning that you don't have to go through the health check. You can apply for another term without going to the health check. That's renewable. But yearly renewable in context of universal life is little additional meaning to that. Okay.
Okay, yeah.
Yeah.
Sandeep ji, if you don't mind, can you explain one more time NAR, like net amount of at risk?
Yeah, let me just pull up the chart for that. Okay. So net amount at risk is from insurance company's point of view, right? So if an insurance company is taking some premium from you, right, they are obviously taking some risk, right? So what this concept is that, let's take this example. let's take this example. Okay, this chart. So initially, like, you know, when I took a policy of say $300, you know, for myself for $500,000 per year policy, first month I paid in $300. If something happens to me at that time, I will give $500,000. I have paid only $300. $300 is negligible, nothing. So insurance company does not have anything from me, but they are liable to pay me $500,000. So the risk is this much. The entire amount gap is the risk. Fast forward 10 years, I may have contributed 300 into 12 into 10. So I have contributed $36,000 by that time. And that money kept on increasing, growing. So my my funds value have reached to this amount, let's say, right? If something happens to me at 10 years, company already had chance to grow my funds up to this much, right? So if they have to still pay $500,000, their risk is what? 500 minus what I already have in the fund, right? So this is the risk. So now the risk has reduced, right? And there will be some point of time where, like, my fund value will surpass the liability, right? In that case, my death benefit will increase. So I may have signed up a $500,000 policy, but it may well happen that at the age of 75 years, this the value of my fund has surpassed $500,000, and I will get more because like they will give me higher of the fund value and death benefit, the initial amount, right? So net amount of risk. So initially, insurance company has much higher risk, and later on it keeps on reducing. So that is a NAR. Okay, Molly bhai, it's good.
Yeah.
Okay, and then there are different variations. So, like, you know, you can. So there are some policies where you will get the fund value plus death benefit. So in that case, this will be like this. Like, you know, here, if something happens to me here, I will get the death benefit of $500,000 plus my fund value. So this is obviously higher benefit, and hence to be higher cost as well. Okay, so this is another variation of universal life policy. You can decide whether you want level death benefit or you want level death benefit plus account value. Okay.
Okay.
Good. Okay, so yeah, tax deferral guarantee. I think Swetaji, you were there in the last class? I think so. Yeah. Let me just finish my class. Okay. Sorry. Okay. Okay. So, Monique, any other questions?
Not now, sir.
So you have covered till which one? Universal life, your chapter you've done?
No, I have completed till 4.4. Like I'm going to start in 4.5. Investment compensation.
4.
Investment components. Yeah, I'm going to start 4.5.
Okay, good. Okay, and investment choices and stuff, like, you know, just where you're going to put the money. That's it. Like which kind of things, right? Yeah. Okay. Okay. So you want me to continue to the next chapter, or shall we? So last class, I think we've gone till chapter 6. No, sorry. Oh yeah, 6. Yeah. Sujataji, I'm trying to recall. You were there in the last class? You're on mute.
Go ahead, boss.
I joined in the later half, so yeah, I was there for the later half.
So where did we stop?
I don't remember that. Sorry.
I mean, the last session is recorded on the video. Like I sent you the link already, so maybe just go through that again. So you can cover Maulik, the last session, just to go to the video. I think I shared that in the group, so you can just check that. Okay.
Okay.
Yeah. Okay. So let's go with the taxation of life insurance and tax strategies. So some of these concepts may be a little bit, I don't say advanced, but I mean, you will not have to really go deep into that one. Given that exam is open book, so like as long as you have high level concept, you can also search and you can find the answer for that. So we'll just discuss about high level concepts here. Okay. So taxation. So one of the very big bit. Are we coming meeting now? Are we coming? She's there. Okay, so first concept about like the very important feature for life insurance is what? That the death benefit is tax free, right? Okay, so when we are paying the premium for that, we are paying that with the tax paid money, right? So if you are getting a salary from your employer, they already have deducted the taxes from that, and whatever money is remaining in your account, you are using that money. You're not getting a tax deduction for your contribution to insurance, right? So you are paying tax paid money. The benefit that is coming to the family or to the beneficiary, that's going to be tax free. They don't have to pay any taxes on that. So that's one of the biggest differentiators between insurance and any other investment, any other class of asset, right? Second is policy disposition. So policy disposition means what? So disposition means like you can there are different ways where the policies can finish, right? So one is that as policy holder, you can decide to surrender all of the policy or part of the policy. Surrender means what? Surrender would mean that you are telling the insurance company that you don't want to continue any further, so they will stop the benefit at that stage. Coverage will stop, okay, and you will get some like in certain policies like so life whole life, whatever the funds, you'll get that those funds minus some certain charges. You can withdraw some cash from the policy, okay. You can take out a policy loan. So policy has certain fund value, so you can go to a financial institution like a bank, and you can tell them that against this asset you give me some money, and they'll charge you some interest rate, okay. Participating policy pays out dividends. So like whole life policy, they are investing the money in somewhere, right? So if the insurance company is making some money, you can get some dividend in some participating policies, basically, right? So that is another way that you can you're benefiting from that, and policy becomes non-exempt. So that is a like see what government is giving you as a benefit about like tax benefit. They don't want you to misuse that. If you start putting much like more funds than what they are allowing you to, they will see this as something where you're trying to avoid taxes, and they don't want that. Okay, so as an example, in US universal life, if I take a policy of $300 per month contribution for me, there would be an insurance cost minimum, and there will be an upper limit as well. If I cross that upper limit, that will they would not allow that. If my fund value has increased so much, okay, and I want to put that back in the policy, then they would think of this as a tax avoidance thing, and they will make it non-exempt. So we'll discuss that a little bit more in this thing. Okay, so let's take this example. So Brian surrendered his whole life insurance policy and received proceeds of $46,000. The insurance company advised him that his adjusted cost basis was $20,000. So he had a policy gain of $26,000, and 100% of this was taxable. So in this case, what happened was that they did not like the deaths did not occur, and they just want to foreclose a policy. So but the money had grown, right? So whatever the growth minus whatever was the cost, that is the gain. So now this thing here, they did not really complete the purpose of insurance. The purpose of life insurance was what? It was for the beneficiary in case your life is not there, right? But here they did not wait for that. They did not they changed the meaning of this investment, right? They sold that, and whatever the proceed they want to keep for that. So government is saying that in that case you give me the tax. Okay, that's it. So what is ACB, or adjusted cost basis? This is a very common term that you'll be seeing there. So ACB is the cost base of an insurance policy for tax purposes. So let's say that let's say that you bought the policy, you're contributing $300 every month. Okay, so in next 10 years, how much is the contribution? $300 into 12 into 10. That is my cost, right? So that will be my ACB, adjusted cost basis. Okay, whatever is my cost for that, right? So let's take one example here. So ACB will so some things will get added here. So for example, if I got some dividends, from my this thing, let's say whole life policy, we get some dividend, participating whole life policy, right? If that dividend I reinvested and I bought some additional insurance, so in a way I took that money and I added that towards my cost, I got more insurance. So there is additional cost. So that will get added to your base premium that you had paid. Okay. If you paid, so interest paid on a policy loan. Okay. So if I took a loan against a policy, right, and I was paying interest towards that, that will get also added, right? So some of these things, I mean, you don't have to go that deep. If they really ask you a pinpointed question, just look for that and find the answer and do that. So I'll not go in that much depth. Just think of this thing. ACB is basically the cost that you incur genuinely for your insurance coverage.
Can I say something?
Let's
say I bought this house at 550,000. So the ACB for this house for me is 550,000. And when I sell it for 101.5 million, then my gain is 100,000. I mean 1 million. So ACB is the cost, actual cost basis, actual cost.
I'll just add one more thing to Parimal's example, great example. So let's say Parimal bought this house at $500,000 and it sold at $1 million. Now, it may be that he now further added a basement into that. The basement was unfinished. He added, he made the finished basement. So now that cost which got added there, that will also get added to his purchase price. So he might have invested $50,000 more, so 500 plus $50,000. Okay, so that is similar to what I was telling you earlier. Yeah. So all that cost that you're doing, now your house value is increased because of that basement addition. It became more than, it added $100,000 value to the house. So your benefit has increased, but your cost also increased. Same thing here, your dividend you use to increase the policy coverage, right? So your benefit is increased, but you added the cost. Your dividend could have gone to you, but actually you put that back there. Okay, so now that dividend is also part of your cost. Okay, like that, right? So yeah, just understand the term ACB is what? ACB is basically the cost of your, what the premiums that you paid plus whatever additional elements.
Purchase price.
Purchase price, basically, yeah. Okay. Taxation of a full surrender is so in that example, the money was $46,000 and the cost of $20,000. So the remaining amount is taxable. So that's what it's saying. Policy gain is equal to proceeds of disposition minus ACB cost. Okay. Taxation of partial surrender. So you're withdrawing part of the accumulated funds. So let's see this example. Instead of surrendering the policy entirely, Alicia decides to reduce the coverage from $200,000 to $150,000. This is considered to be partial surrender, and she is deemed to have disposed of 25% of her policy. So percentage disposed is 50,000 divided 20,000. So 25% is surrendered. Recall that policy has a CSC of 24,000 and ACB of 10,000. So Alicia will receive $6,000 upon reducing the coverage. So so CSC was $24,000. She surrendered 25% of that, so she got $6,000. Okay, so that is the CSV that is associated with that, and yeah. So and the ACB was 10,000. So ACB for that portion was $2,500.
Okay, here's the thing. Let me explain you. See, your policy is 200,000, right? And your ACB is 24,000. Now you surrender 25% of it.
Just 6,000.
So what will you get? You have 24,000 ACB. So your purchase, you're getting a refund from 24,000. So what is 25% of 24?
6,000.
So that's what you're getting.
Okay, but there is the amount written ACB of 10,000. What is that?
What? CSV of 24,000 and an ACB of, so he's getting CSV and ACB. Now ACB will come into action 2,500. So 6,000 minus 2,500 is 3,500.
That is where they pay the taxes.
Yes.
Okay.
If they surrender the full policy, you have gotten 24,000 minus 10,000, 14,000, right? So you surrender 25% of the policy. So it's 14,000 into 25%. That is $6,500. Simple, right? Full gain ka jo 25% rahega, that would have been your the corresponding policy gain for partial surrender, and based on that, you'll pay the tax at your whatever marginal rate for that year. You'll pay that way.
Okay? And you are asked such a question.
Yeah. So
yeah.
So I don't want to go into too much technical here. I just want to give you the feel of the concept, but I would encourage you to try these examples and see that, right? Okay, taxation of so policy loan. If you are taking a loan against the policy, you are not going to pay the tax on that, right? Because dean proceeds are nil. Okay, you are not sold a policy, right? You are just taken a loan. So on the loan, you are not going to pay the taxes. Okay. Taxation versus non-exempt policies. Okay. There's one thing here. This date is important, December 1, 1982. Okay. So that is.
Sir, आपका freeze हो गया.
Hello.
पानी चालू.
Can you hear me?
Oh. What happened, sir? It dropped.
Yeah, sorry, there's some net connection issue. Once again. Okay. Okay, maximum tax actuarial reserve. Kanal bhai, you want to take a shot at that? Explain that.
I don't remember this much. I have to read it.
Okay, so okay, let's look at this chart. So let's say that I'm paying a certain amount, say $300 I'm paying every year, right? Sorry, $300 every month times 12, so $36 every year I'm paying, right? So I kept on paying this thing, right? And my fund is growing this way. Okay. So this is my this is the way my fund is growing, right? So at this point of time, my growth, sorry, here my deposit is this much. My fund is only this much because some of the funds have gone to insurance, right? So my fund has only this much remaining value. So in the initial years, I may have contributed more. My fund value is less. Later on, this keeps on accumulating, and at some point of time, this accumulating fund would grow to a higher amount, right? Okay, so the government is going to give me an exemption on tax only to a limited amount. Okay, so the cash value of a policy accumulated fund, so in this case universal life, right, that cannot exceed the just 1 second.
એ ઓન છે પેલાની કંપની કે એ ઓન છે?
Okay, sorry guys. So what I was saying was that so maximum tax actuarial reserve basically is like government's way of calculating whether you are putting too much money into insurance policy and you are trying to basically avoid taxes, right? So they are so this calculation basically is telling them that up to this amount you're tax exempt. If you're putting too much money into that, and that goes that extra money that will be taxable.
So is it mentioned in the policy when the client purchased the policy? Is it mentioned that maximum amount you can put, like that much amount you can put?
Yeah, so the insurance company will basically advise you that you are now exceeding your your fund has this much extra value which is going to be taxable. Okay, so you have to either pay the taxes on that one, so you keep that into a separate account. It's called shuttle account. If you keep that in shuttle account, you just pay the tax on that that component. If you do not do that, then the entire policy can become taxable.
Okay.
So insurance company will advise you, but now what has happened is that some of the insurance companies, every time like the policy holder may not be like really conscious, so they have created an automatic separate account where that extra amount will go and sit there, and they just take your consent that you will be paying tax on that portion. So the balance of your policy basically like the policy is not affected. If that was not done that way, then your policy becomes invalid because government is now considering that your main purpose of this thing was investment and not insurance. Okay.
So is the exempt amount same for everybody?
No, it's not for everyone. So it depends on how much coverage you have taken. Based on the coverage, your target premium is calculated, and maybe twice or 3 times or 3.5 times of that would be your maximum limit, right? So it depends on how much was your extra room. Have you utilized all your room
I see.
or not? Okay, so like you are not like they basically do not want you to start dumping money into that and start using this for as a tax avoidance thing. So like for example, it says another thing is anti-dumping rule. So it prevents the policy holder from making large lump sum deposits to the policy after its 7th anniversary. Okay, so sometimes people they would try to put a lot of money here just to take advantage of the tax benefit. So they are putting some these kind of rules so that like you're not using this thing for tax evasion or avoidance. That's the reason. Okay, so taxation of insurance policies are kind of a little I don't say it's slightly complex, but just the concept, like if you get the concepts, that should be fine. There may be a couple of questions on that front. Okay.
Main thing to understand is if the benefit is paid out to beneficiary is tax-free. If you're trying to withdraw money from it as cash surrender value, then you're paying taxes. If you're taking a loan out of it, no taxes. If you're leveraging it, meaning if आप गिरवी रखते हो उसको बैंक के पास, no taxes.
Okay, so I have a question on it. For example, if I have put $50,000 in, like my cash surrender value is $50,000.
Okay.
So am I like, do I have to pay 50,000 like tax on a 50,000, or whatever the increment I have to pay on the tax?
As long as it's sitting there and you're not using, not withdrawing it, you're not paying any taxes.
Okay.
Only if you withdraw from it, then you are paying on that one.
The whole amount I have to pay tax on whole amount.
Not the 50,000, whatever amount, let's say you took out 10,000, you took out 10,000, it's 20% of 50,000. We were calculating that up just in the previous example.
But what is his question is, I think, does he pay the tax on the amount he has paid or to the gains, right?
He
Yes.
doesn't,
Maulik bhai?
but
Yeah.
see, if you don't use the gains, the amount you have paid, you have already paid the taxes when you earn the
When you,
money.
yes, yeah.
So you pay the taxes on the
Only
growth.
on the gain.
Only gain money we have
That's
to pay.
what that is what is called policy gain.
Policy
That
gain.
is what we calculated here.
એટલે 50,000 માંથી તમારે સોરી સંદીપ, I'm talking
No,
in
no, go ahead,
Gujarati.
please. No problem.
50,000 માંથી 10,000 નો નફો તમને થયો હોય તો તમે 10,000 નો જ
10,000
આપો
ઉપર
tax.
tax ભરવાનો.
બરાબર.
If you withdraw it,
જો
Okay.
લો તો ના પડ્યા રહે તો આપણે કઈ ટેક્સ
તો
નથી ભરવાનો.
ભરવાનો
it's
નથી.
tax deferred.
અને આપણે મરી જઈએ અને આપણા છોકરાઓને મળે તો એ લોકોને તો ટેક્સ
તો
ભરવાનો જ
tax
રહેશે.
ભરવાનું છે જ. ફોર એક્ઝામ્પલ મેં પોલિસીમાં 40,000 મૂકેલા છે, 10,000 નું ગેઇન મળે, તો એ જે 40,000 છે એ મને જ્યારે યરલી ટેક્સ ફાઇલ કરું એમાં મને લાઈક એ ડિડક્શન મળે છે એમાંથી કે
ના
ના, એ તો
ના
તમે
મળે.
already તમારા પગારમાં તમે tax ભર્યો
ભરેલો
પછી
જ.
ભરો છો.
Yeah.
ઓકે
That money you are paying out of your tax paid money.
ઓકે
આ RRSP જેવું ઇન્વેસ્ટમેન્ટ
Like whenever I get my salary, my taxes are paid and I'm paying my premium out of my salary. So I've already paid taxes on that.
ઓકે અન્ડરસ્ટેન્ડ.
એ તો બિઝનેસ વાળા છે ને એટલે that's why he's thinking like that, right?
Yeah, like I was getting,
Self-employed.
yeah.
Sandeep ji, correct?
Sorry, मैंने follow नहीं किया.
ईमेल पढ़ रहे थे अपना आप.
नहीं, मैं ये पढ़ा था इसका आगे कौन सा टॉपिक बोलना है.
नहीं, मौलिक भाई ऐसे पूछ रहे थे कि अगर मैं 40,000 डाल रहा हूँ पॉलिसी में तो वो 40,000 को मैं अपने टैक्स में विड्रॉ कर सकते हैं एज एक्सेप्शन, डिडक्शन नहीं हो सकता.
ओ आपके प्रीमियम को, कंट्रीब्यूशन को?
हाँ,
नहीं.
इंश्योरेंस का
That
प्रीमियम
depends who is the owner of the policy. If the business is the owner of the policy, it's a different case. If the person is the owner of the policy, it's a different case.
Okay.
Like if
बिजनेस
you have a business,
एक्सपेंस से डिडक्ट नहीं कर सकते उसको. लाइक बिजनेस में फायदा ये है कि आप आपको जो टैक्स पे करना पड़ा बिजनेस को, यूजुअली 12% 15% टैक्स पे करना होता है, तो वो पैसा और टैक्स बिजनेस अपना पे करेगा. उसके बाद you can use the funds to put for the insurance for the owner or like key person, but usko you do not deduct from the expense. Like idea is ki do not take the tax exemption upfront, so your benefit will be protected from taxes. Like once, like one side you have paid taxes, so the other side you're not paying taxes. That's the fundamental.
that's the fundamental.
Yeah. Okay. So be it business or be it like you individual, you are paying for the insurance from your tax paid money.
Okay.
Okay.
Yep.
Okay. So like couple of things, like one, so tax life insurance strategies, taxation. So using the policy for collateral, do we understand this thing? So I'll explain to you with an example. So like I have a $300,000 policy, $500,000 policy, let's say, and in year 15, my fund value is $150,000, and I'm retired. At that stage, I don't have any other income, and I want to gain some money from that one. So that $150,000, I can put that, like I can put my policy as a collateral. So bank knows that okay, I have $150,000 sitting in my account at that time. So they may say that, okay, I will pay you, I'll give you a loan of up to 60% or 70% of the fund value. So up to $90,000 or $100,000 out of the $150,000, fund value, you are able to take as loan partially, like, over a period of time or in one lump sum. So the bank is treating that as security. If something happens to you, then the policy will be paid like $500,000, right? So from that, they will deduct the money. Okay. and then you can the balance of the money will be paid to the beneficiary. And reason why we are doing that is that, like, if you are taking the money as loan, then we don't have to pay the taxes. So it's mainly for tax management. Okay.
I
So
have a question.
Yes.
So what kind of fees and surcharges would a bank apply if a person dies and they have a loan, collateral benefit loan they have taken from the policy?
So bank, like, it's just like, for example, house, right? So if you have a house of $1 million, and you're going to the bank, your bank will say, that, okay, I'm willing to pay you up to 70% as a loan. I'm willing to give to you of the value. So you can get up to $700,000, right? So now it's for you to repay that money. They will not charge you additional, they just charge you interest. They may give you, like, prime plus 1%. They just charge the interest. So there's no surcharge as such. Similarly, in the policy, like, they're going to tell you, like, I'll pay you I'll charge you 4% interest or 6% interest, whatever, right? So you're just paying that interest for that. And like, you are not paying in a sense, like, unlike the mortgage where you are paying every month, in case of insurance collateral, bank understands that you are not in a position to pay that money every month. Actually, you're trying to use that money because you did not have the money to begin with, or you're short of income. So the agreement, or what bank is saying that, okay, enjoy this money as a loan, and eventually sometime you will pass away. At that time, either you'll pass away, so that benefit will come, or if you surrender the policy, from that policy, that money will be realized, whatever is the fund value. So I will take my money from that, and balance what is something remaining, that will go to your beneficiary. Okay.
So the interest calculation would be compounded, and they will make their money from that interest.
Yes, because, like, if I'm taking $3,000 every month, then obviously, like, and you're not paying any interest, so that you'll be paying whatever 4% rate every year, so that will be compounding till, so like, your settlement is happening upon your expiry, right? When you are passing away, so till that time you have to pay the interest. Yeah. Okay.
You are not paying. Your policy is paying.
Yeah, your policy is paying. No, but the good thing is that while you may feel bad about paying that interest, but your money, which was sitting in that policy, the fund, that was never taken out. So money was still there in the investment vehicle. Investment vehicle might have given you 6%, 8% return. So on one hand, you are getting 8% return, and the other hand, you are giving 4% charge to the bank. So you would want to do that, right? You are getting interest money on lower rate, and you are benefiting at higher rate.
You can also deduct that interest amount from your tax.
Yeah, usually that is for the business.
If you are
business
paying,
can do that. Yeah.
You can pay and deduct it. It is a better option.
Yeah, business can.
if you're making enough money.
Right. Okay.
That's the goal, to make enough money.
Annuitizing is what? Annuitizing is basically, like, for example, in that example I mentioned, I have $150,000 accumulated. I can tell the bank that, you keep this money, and whatever is the proceed for that, and I will, give me an assured income of $2,500 every month till end of my life. And bank can do that, right? So they will look at how much is the CSV of for you this thing, and based on that, they will tell you that, okay, based on this amount, I'm comfortable to give you so much of your money every month, right? So that is called annuitizing. Okay. Leveraging a life insurance policy is basically what we say, like, you're getting the money from the bank at lower rate, and then you are getting more return from that. So you might want to actually take more loan, and that way you can and you can increase your contribution. So basically, like, you have an opportunity to get more return with some cost, you can get more return. So that's leveraging, right? Okay. Okay, so this is slightly detailed one. I can't go into all the details, but just go through that video on this thing. Whatever is there in the video, I think that is more than sufficient. And look at some of the examples. I think that should just give you sufficient clarity for that.
Taxation part, I would suggest just understand. Don't try to like digest it right now.
Yeah.
Understand the basic fundamentals of all the insurances and watch the video. In the video, there are 2 videos. And that person, that gentleman talks about like he always says this is always asked in the exam.
So
Make sure
focus
you
on
read it
those
again.
questions.
This is always asked in the exam. So pay focus on that, and if questions come back, because taxes and we are not tax consultants.
Yeah. Okay,
It's a
good.
huge subject.
Okay. I'll just take another 5 minutes. So I will quickly introduce you to this topic, and then we'll stop. So business life insurance is what? So as we mentioned, like, business, see, for any business can survive only if, like, the owner is there, right? Somebody has to be owning the business, right? So if the owner passes away, the business becomes like it may not sustain. So for business to survive, it has to it can take insurance of its owner. Okay, so that is allowed, right? So so if like, I'm running a small business, and if I'm running a bakery, right? I'm the chef there, right? If something happens to me, then I have to say that there is the loss of skills. I may have taken some money from the bank. The creditor money will be due. Nobody's there to take care of that. I may have a partnership with someone else, and that person, if that person passes away, their family have the shares, and they may start, like, interfering in my business now, and my business may not run smoothly. So that is an issue, right? And let's say, someone has 3 or 4 different children, or like people who they want to pass the benefits on, but there's only one business, right? So how can you distribute one business into 4 people? That becomes very complex. So that's another issue. And if the business has made money, it has gained value, so there's a capital gain, and there's tax to be paid for that. So these are the problems which will happen, if, like, the key person or the owner of the business passes away. So these are the things that the insurance is trying to take care of. Okay, these are 4 or 5 different issues, right? So now business types are what, like, so proprietorship, one guy basically running the business. Partnership is like, 2 or more different people. They have the business ownership, and they have full responsibility. And corporation is basically where you're doing a limited liability company, where your personal assets and liabilities are different from company's assets and liabilities, right? So that is corporation. So there are these 3 different types. Okay, so okay. So let's look at this in key person life insurance. So key person will be who? Key person will be typically the owner, or like, a director, or board member, something like that, which are too important for the company to run. So that's key person. Okay, buy sell agreement. Let's try to understand that. So, like, let's say, myself and Parimal are partners in the business. Okay, we both have 50% of the share of the business. Now, if something happens to me, Parimal may not want my family member to step in into the business, because, like, I and Parimal had like same wavelength. My family member may not have the same wavelength. They may not have the same skill that he requires. So what he would like to do is that he would want to, in that case, the ownership of the entire company should go to him. But for doing that, now he has to buy the share of 50% from my family member, right? So insurance policy is basically coming picture here, where the agreement between Parimal and me is that he is taking an insurance cross purchase agreement. He's paying for my insurance. So if something is happening, the benefit of that is coming, and that money he's using to buy my shares, and vice versa. So both the partners have taken this approach, where I will pay for his insurance, he will pay for my insurance. If something happens to me, the benefit will go to him. Using that money, he will buy my shares. So he has the full ownership of the company, and the benefit have gone to my family. That is cross purchase agreement. Modi bhaiya, samajh mein aa raha hai? This is okay?
Perfect. Yeah.
Okay. So these are benefits like, you know, guaranteed buyer, your guaranteed value, mandatory sale. Like you don't want that share to go to somebody else. Like, you know, you don't want to deal with all those things, right? Okay. So that is the main thing on that front. And this is slightly involved there, where basically like the company, it's same thing in a like longer twisted manner, where the company is now paying for the insurance amounts, and the benefit is coming to the company, and the company is giving that you know, benefit to the family, and the shares from that family is coming to the shares from that company, that family member is coming to the company. It's like this. I mean, spend a few minutes on this one. It's basically achieving the same thing, but it's like company is doing a step. Not the people are not directly paying the premium for each other. The company is paying the premium or on their behalf. Okay, it's mainly the same thing. Okay, and okay, funding share resolution. So yeah, so only that is the thing on that front. So that is all on the insurance front. The remaining is more about application and writing. So how you take all the information, what the insurance company will review while you know, this thing while approving your policy or not, that kind of those kind of details. But I think in terms of the product, you understood you know, what are the use of these products, which scenarios they are going to be used. Okay, so I will stop here. The assignment will be to cover now till chapter 8, and definitely like watch the video a couple of times. I think that's you know, covering all the important things there, and take full advantage of the incentive scheme that we have started for our team members. So I don't think any team has done that. So I do believe that in my knowledge, we are the first team which are offering that. So I mean, you know that you are in this business for as a salesperson, you have to do this anyway. So why don't just jump on this opportunity and make some like, you know, just pay for the expenses quickly. Okay.
Yeah. Yeah.
Okay. Perfect. Anything to add?
Thank you, sir.
All good.